Hey everyone, and welcome. Today we're going to talk about a number that pretty much every investor sees, but a lot of us might misunderstand. The dividend yield. It looks so simple, right? But that high number you see can sometimes be a trap. Let's get into why.
So let's just start with the basics. You put your money in a stock, how do you actually measure your return? I mean, is it just hoping the stock price goes up, or is there something else to it? For a lot of people, that other piece of the puzzle is the dividend.
And that's exactly where dividend yield comes in. You can just think of it as a simple little ratio, a percentage that tells you how much cash you're getting back in dividends for every single dollar you've put in. It's one of the go-to metrics out there.
And the math behind it? Honestly, it could not be easier. All you do is take the annual dividend the company pays per share, and you divide it by the current stock price. That's it. You get a nice, clean percentage that's super easy to compare. Okay, let's put some numbers to this to really see how it works. Let's say we have two companies, Company A and Company B. Now they both pay the exact same dividend, $1 a share. But look at the difference in their stock price. Company A is trading at $30, while Company B is down at $20.
So when you actually do that simple calculation, something really interesting pops out. Company A has a yield of 3.3%, but Company B, just because its stock price is lower, suddenly has a much more attractive yield of 5%. So on paper, it looks like you're getting way more bang for your buck with Company B, right?
I mean, looking at this chart, it feels like a total no-brainer. A 5% return is obviously better than 3.3%. So you should just pile all your money into Company B, right? Well, hold on a sec. This is where things get a little more complicated and where that simple number can be really deceptive. First, let's talk about Company A, the one with the lower yield. I know it sounds kind of backward, but sometimes a lower yield is actually a great sign, a sign that you're looking at a really healthy company. Here's what I mean.
Just picture it. Company A is firing on all cylinders. They're innovating, their earnings are awesome, and everybody's excited about their future. So what happens? A ton of investors want to get in on the action. And it's just basic supply and demand, you know? When everyone wants to buy a stock, the price gets pushed up. So as investors pour in, that share price climbs from, say, $20 to $30, but, and this is the key, if the dividend payment stays the same at that $1, the yield automatically goes down. So in this scenario, a lower yield is just a side effect of a stock that's soaring in price. That's a good problem to have.
Okay, so now let's flip the coin and talk about the high yield trap. This is something every single investor has got to be aware of. This is the story behind that really tempting 5% yield that might not be what it seems. So let's imagine Company B is in a bit of trouble. Maybe their sales are falling off a cliff, or a competitor is eating their lunch. Investors start to get nervous, they lose faith, and they start heading for the exits. And as investors start selling off their shares, the stock price tanks. Let's say it drops from $30 all the way down to $20. Now, here's the trap. If the company hasn't officially cut its dividend yet, the math gets warped. That same $1 dividend is now being divided by a much lower price, which makes the yield artificially jump up to 5%. In this case, that high yield isn't a good sign at all. It's a huge red flag. And here is the real danger. That high yield payment is based on a promise from the past. A company that's struggling is probably going to cut or even get rid of its dividend completely to save cash. That 5% yield you were so excited about could literally vanish overnight, and you're left with a sinking stock and no income. So, look, this is really the whole point. You just can't take dividend yield at face value. You have to ask the big question, why? Why is the yield high? Is it because the company's in trouble? Or why is it low? Is it because the company's stock is soaring? The story behind the number is everything. Okay, so how do you dodge the traps and find the genuinely good dividend stocks? Well, the goal isn't just about finding a high yield, it's about finding a stable and reliable one. Let's break down what that looks like. The smarter way to go about it is to look for those big, established companies. You want to see a solid track record of two things. First, consistent, reliable earnings year after year, and second, a history of not just paying their dividend, but actually growing it over time. That is the true sign of a financially strong company. So we'll leave you with this to think about. The next time you see a stock with a super tempting high dividend yield, what's the very first question you're going to ask yourself? It's not about the number itself anymore, right? It's about the story behind it. Is this a sign of strength, or is it a warning of a trap?